Welcome to the Chartered Financial Analyst series of videos. As usual, I provide a small introductory slide about my qualification and experience. Today, we will continue with the topic of corporate finance and equity, and this is the video number 8, which will be the first video in cost of capital. The cost of capital will be the first topic we will discuss today. So let us begin. We will start by defining what we mean by cost of capital. First, what is meant by capital is not only the equity, which is the share capital provided by the owner plus retained earning and other reserve. That is the shareholders' equity. We don't mean only the equity part, but capital also encompasses the debt that the company get from lender. So normally the company provide finance for their investment through equity and debt. This is what we mean when we say cost of capital. The capital means equity plus debt. So how to calculate the cost of our capital, which is being provided by the equity and the debt? It makes sense to say that cost of capital equal the cost of equity plus the cost of debt. So if we say that the cost of a company equity is 12 and the equity in the balance sheet is $1 million, and the company also borrowed $10,000 to finance their operation, for which they pay 3%. So as per this equation, we should just simply add the cost of equity plus the cost of debt. 12 plus 3 will give us 15. But this doesn't seem right. Something isn't right. Shouldn't we take the average of both? Especially that the topic today is average cost of capital. So what would be the average of 12 and 3? It will be 12 plus 3 divided 2. Simple arithmetic calculation. This is the average of both, which is 7.5%. So now, what's the right answer? Is it 7.5%, which is the average of both equity cost and debt cost, or is it just adding them together and get 15%? The calculation so far doesn't make sense, but let us do some small calculation. How much it will cost the company annually in terms of interest payment to the debt holder? I borrowed 10,000, I pay 3%. That means I pay 3 times 10%. Also the equity, 12 times 1 million, I will get the amount I pay on annual basis. So the debt will cost the company only $300, while the equity costs the company $120,000, which is 12% times 1 million borrowed. So by adding both, I get the figures in amount, in dollars, how much the capital provided by the equity owner and the debt holder. It will cost the company 120 plus 300. So it makes sense to say that the cost of capital equal what I pay in form of interest divide the both amount I got, 1 million and 10,000. That is the total finance provided by the equity holder and debt holder. So it will be as simple as this. This is the $300 I pay on the debt, and this is the 120,000 I pay on equity. This is the value of the equity plus the value of the debt. That is the total finance provided by equity and debt. I pay 120. If we divide this, we'll get a figure of 11.91%. This is the average cost of capital. Let us do another example, assuming a different structure. Instead of huge equity and a small debt, let us do it the other way around. Now we have huge debt of $90 million and a small $10 million in equity. So this company is heavily financed by debt. So what would be the cost of capital if, again, the debt costs 3% as the previous example and the equity costs 12%. So what we will pay on the debt is 3% times 90 million borrowed. I will pay 2.7 million annually. For equity, I pay 12% times the 10 million value of equity. It will be 1.2 million. So both will be the money I pay to get the capital, which consists of debt and equity. So divide the total amount of debt and equity, I will get the average. 2.7 million interest on debt, 1.2 million the cost of equity, divide debt plus equity. The total finance I'll get, which will be 3.9%. There is a point here I'm trying to make. If you notice in the first example, the average move close to the 12%, the cost of equity, 11.91. Here the average move close to the 3%. Why is that? It is obvious because here we have heavy debt. This is why the average tend to move towards the cost of the debt because it's huge debt. Here the equity is huge and the average tend to move close to the 1 million cost, which is 12%. So it depends on the weight of the debt and the weight of the equity. So the crucial words here is weight. The average is affected by the weight and tend to move close to the portion of the finance that is heavily used in the company's balance sheet. So it is a weight like this, simple weight. So you see here the weight is heavy and here is very light. So this is the equity of 1 million, heavy equity, and this is a very light debt of 10,000. In this way, the weighted average cost of capital will be close to the heavy equity, which is 12%. Now, just now I mentioned about the weight and I explained it. But how do we calculate it? The weight is simply the value of the debt. If I'm looking for the debt weight, the value of the debt divide the total finance. So in our example, we have debt 90 and equity 10. By the way, these two figures are called capital structure. How the capital is structured? More debt and less equity, or the other way around? Is it more equity or less debt? So that this will affect the cost of capital. And normally, the cost of debt is cheaper because debt is secured. Either the owner or the debt holder get hold of one assets and mortgage them, or any type of security. In case of bankruptcy, the debt holder will be paid first and the shareholder will be paid the last. This is why equity is risky. Since it is risky, they will ask for higher return. The higher return will be a very high cost of equity to the owner or to the company. And the debt will be cheaper because it is secure debt. As we mentioned in previous videos, that the higher the risk, the higher the required rate of return. This is why equity is always more expensive than debt. To get the weight of equity, I divide 10, divide the total finance. This is 10 million, divide the total finance I got, 90 plus 10. Equally, if I want to get the weight of debt, it will be 90, which is huge, divide the 100. This is the weight of the debt. So in terms of simple algebra, we say weight of the equity equal the value of the equity, 10 divide debt plus equity. Debt plus equity. This is the total finance in the company, and this is the equity. I'll get the weight. Here it is the other way around. I'll put the debt first, divide the total. Now, what's the weighted average cost of capital as per this formula and the discussion we have so far? It will be like this. The weighted, as I said, this is the weighted average, because we divide by the average. Cost of capital. Capital means debt and equity. Cost mean required return by equity, which is 12%, and the required rate of return by debt holder or provider of the debt, which in our case is 3%. So I multiply the cost of equity times the weight of equity. This is the weight of equity. Weight of equity. Equity divide debt plus equity. Similarly, I multiply the required rate of return by debt holder times the weight of the debt, so that I get the average for the cost of debt, and here I get the average of the cost of equity, and this is why we call it the weighted average, not just a simple average. There is a simple average by adding and subtracting by the dividing by the number of figures, but the weighted one is to multiply by the weight of each. Here we multiply by 1 minus tax, which I mentioned in previous videos. This will always be below 1, because 1 minus a fraction, because tax normally 20%, 30, 40%, that 1 minus 40% will give 0.6. 0.6 times anything here will give lower cost. This is why we say always debt is cheaper, because the tax shield, as we mentioned in previous examples and videos, that this is called tax shield because it shields the profit from being taxed. So it will lower the cost further, because you pay less tax compared to equity. Equity dividend payment to equity holder is not tax deductible, but interest 3% paid to debt holder is tax deductible. So I get a benefit of having more debt on the capital structure of the company. So it makes sense. Why don't we go 100% debt, or only $1 nominal value for equity, and the rest of millions we get it in debt, because 3% is very cheap. Why should I get more equity, which is very expensive? This question, we will answer it when we come to the capital structure. Things are not that simple. But next will be the video number 9, which will continue the cost of capital topic. But then, as I mentioned just now, we will go through the capital structure and its effect on the weighted average cost of capital. It has effect. The more debt you have, the less weighted average cost of capital you get, up to a certain extent. It's not always. Otherwise, we'll get all the debt and forget about the equity. It goes until certain level. Beyond that level, it will be very expensive. There is some theoretical background behind this, but I'm not going to go into detail with this, because this will be in level 2 and level 3. Why we can't take a debt indefinitely, since debt is cheap. This is a theoretical discussion. I leave it to level 2 and 3. Before we go, you are being reminded to subscribe to the channel so that you get all the series. Thank you.